Liquidity and fair value gap are both very strong profitable trading strategies, but a lot of traders trade them individually, which is wrong. Liquidity trading alone has made me more than $170,000 in trading profits, and fair value gaps has made me almost $100,000 in profits. And that is because I traded liquidity more than the fair value gaps. Now, if these two trading strategies are giving me these crazy amounts of profits, imagine what will happen when I combine the both of them together. The results are mind-blowing. This is the best liquidity trading strategy that you will ever find. This trading strategy increased my profit margin exponentially, and it will actually do the same for you if you follow these steps carefully. You will find yourself making profits at ease, and the best part is that it is not hard. No, it is not quantum physics. I am not one of those traders that will confuse you with impossible trading setups. I have made everything simple for you, as simple as spelling the name of your girlfriend, so that you can remember them easily and identify them fast on your chart. But before we get into this incredible strategy, do well to like this video, so that other traders can discover it and also become profitable, and subscribe to our channel if you are new here. So my tribe soldiers, let's get down into the business. To simplify this strategy, we are going to be following 5 layers of concepts in this video, from the beginning to the top of the pyramid, following everything step by step. Now, what is liquidity and fair value gap? Liquidity are those areas or levels on the chart where there are lots of trading orders waiting to be filled in the market. These are areas where there are large influx of trading orders, such as the stop loss, take profits, buy limits, sell limits, buy stops, and sell stops. When the market trades into these levels of higher weighting orders, price rises or falls significantly, depending on the target reaction. As traders, we expect a strong reaction of the market price at that particular point, and that makes it a great zone to trade in the market. The fair value gap, on the other hand, is a smart money strategy, which is a price gap on a chart that occurs when the market moves very fast in one direction, leaving a noticeable space in between candlesticks, showing us that there is an imbalance between buyers and sellers at that point, and giving us a hint that the market will return to that area again and fill the gap in order for the market to balance itself again. Now, some people might say, is the fair value gap not a common occurrence in the market? Like the other candlesticks movement, what is so special about it? The truth is that these gaps are actually not common in the market. They only appear mostly at strategic points on the chart. In a market where the candlesticks are always overlapping each other as they move in a balanced state, these gaps appears to show us that there are some unfinished business that the market will soon go back to do before returning to the target direction. It is a whole new perspective on its own, but the truth is that if you want to actually make money using the fair value gap, you cannot use every fair value gap you see in the market, as some of them happen at random areas on the chart that will not really lead you into profitable chances. And because of that, I decided to narrow down to some of the best areas on the chart where we can actually expect a great fair value gap structure that has proven to work multiple times in the market. And that leads us to the second concept, the best areas to find fair value gaps in the market. These zones has proven to work immensely, not only for the fair value gap patterns, but for many other trading strategies in the market, meaning that many traders will be very interested in that particular level or area in the market, and they will also be looking forward to sell or buy from that zone, making it even stronger to trade with. These levels are very important on the chart. Do not joke with them. These levels includes the base levels and the flip zones. The base levels are more like the supply and demand zones. We traders always place our target on these zones because they give us the advantage to get into the beginning of strong price movements. The flip zones are more like the breakout zones of support and resistance. This is the point where the market can flip a support zone to become a resistance zone, or flip a resistance zone to become a support zone, Anything can happen at that breakout point or flip zone. But what we will be targeting to find at the flip zone is the fair value gap. The great thing about these two areas is that it is not only the fair value gap traders that are placing their interest on these levels, there are a bunch of other traders in the market that are also looking forward to trade at these levels. These include the support and resistance traders, the supply and demand traders, the breakout traders, the smart money traders, the institutional traders, and sometimes even the trendline traders. Meaning that these areas are high levels of importance in the market, and we are going to be using them to elevate our strategy, because we actually want to focus on where a lot of traders are also trading from in the market. So now that we know the best areas to identify the best fair value gaps, we will now move on to the next step, which is how to combine the liquidity and fair value gap together to take profitable trades in the market. This is where you will have to focus very attentively, as I will be explaining a lot of things here carefully. But before I move into that, I would like to introduce you to our Telegram channel, where I post a lot of trading signals. You will watch me trade and make money on real-time chart with a lot of trading tips that will elevate you to the next level. To join us now on Telegram, use the link in the description box below. So now this is how we are going to be trading the liquidity. In addition to the fair value gap, pay close attention to this. When we combine this strategy, we simply want to make sure two things appear: a fair value gap at an important area, and a liquidity zone before the market returns to the fair value gap, like the way it is in this structure. So here we have a fair value gap identified at the base. And mind you, when we are looking for fair value gaps at the base, we want it to happen at the very beginning of the base. We don't want it to happen at areas such as this and this, when it has already gone too far from the beginning of the base. Doing that will only place your account in a lot of risk and reduce your chances of making profits. So you should always stick to the beginning of the base, as that brings more profits and makes this strategy impeccable. After spotting the fair value gap, the next thing you wait for is an area of liquidity, such as this one. You can see that here, the market made a little move at these areas without getting to touch the fair value gap, which then becomes our area of liquidity. So when the market trades across these areas of liquidity, a lot of trading orders are going to be triggered, which adds even more fuel to the fire. And when it finally touches our fair value gap, it gains even more stronger momentum to rise up and keep moving the market up. The worst mistake a trader will ever make is buying the market immediately after it makes this little retracement and touches the fair value gap. That is a financial mistake, because in 9 out of 10 trades, this area will always be taken out before the market starts making its move up. That's why the combination of fair value gap and liquidity will not only change the way you trade, but will keep you out of a lot of losing trades. See that after the market took out all these liquidity zones, it started rising up exponentially. But there is one more thing we must understand before we move on, which opens us up to step 4. It is called an entry candlestick. For this strategy, we are going to be making use of a complete bullish or bearish candlestick. What I mean here is that we need to see a candlestick that has more body than the wicks, in line with the target direction, to appear at the point when the market clears out liquidity. And here we have a bullish candle, which will then give us the signal to enter a trade, and then do step 5, which is to guide our trade with a good risk management. For our risk management plan, we place our stop loss a few pips below the entry candlestick and our take profit at the next high, or at the point where your greed permits you. Now that you know the full steps to this strategy, let's see another example of this strategy at the flip zones. So here, we have the market breakout of a tangible resistance zone to flip it to a support zone. And at the breakout zone, we have a great fair value gap formation. Notice how it happens exactly at the breakout area. Do not take fair value gaps that happen before the breakout or after the breakout. Always wait for the fair value gaps that happens exactly at the breakout zone. And after that, see how the market started making these liquidity movements. Then the market went down, took out all the liquidity, including this little retracement, and then formed a bullish candle, and from there, the market started moving higher and higher. If you find yourself in a trade like this, you place your stop loss a few pips below the bullish candle and place your take profit target at the next high. And as you can see, this trade was a big success. Now, let's take another example. This example explains exactly how simple this strategy will be. And the truth is that you can find these opportunities almost every day in the market. So here, we have the fair value gap formed at the base, and we draw out the gap. See that the market made some liquidity movements up here. So the market will come down, clear all the liquidity, and then touch the fair value gap and started making moves up. But before it moved up, you can see it formed a bullish candle here, and after that, the market moved up and continued moving up. If you find yourself in a great setup like this, you place your stop loss a few pips below the bullish candle and your take profit target at the next high, or when your greed finally permits you. This strategy is your ticket to making high profits in the market. Take your time to go through it, over and over again, until it finally sinks down into your memory and you begin to make profits from it. If you have a question about this strategy, feel free to drop them in the comment section. And if you are a complete beginner into liquidity trading and you want to really learn liquidity trading from scratch, this video is a full trading course and will guide you into liquidity trading from the very beginning. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.